I'd like to talk now about what the objectives of the Federal Reserve System are, because if we're going to say it's going to, if it were turned over to Congress, it would pursue the same agenda. What is that agenda? Extremely important thing to focus on, because we're told that the purpose of the Fed is to stabilize the economy. And everybody kind of believes that. I mean, when Greenspan comes on and says, well, we're raising interest rates now, why? To stabilize the economy, right? To prevent inflation. In other words, to protect you folks. To protect you. And we buy it. Well, one of the most widely used textbooks in our schools right now, textbook on economics written by Paul Samuelson, explains it this way. It says, quote, "The Federal Reserve sprang from the panic of 1907 with its alarming epidemic of bank failures. The country was fed up once and for all with the anarchy of unstable private banking." It's partly true. It's just they came up with the wrong solution. Just because there's a problem doesn't mean that any old solution that somebody has to offer is the best. In fact, it may be a non-solution. That's what we're talking about. Just turning the system over to the government to run is a non-solution. Well, let's take a look at this. If the purpose of the Federal Reserve System is to stabilize the economy, let's give it a report card and see how well it's done. Since it was formed, it has presided over the crashes of 1921 and 1929, the Great Depression of 29 through 39, recessions in the years 53, 57, 69, 75, and 81, a stock market Black Monday in 87. We all know that corporate debt is soaring, personal debt is greater than ever before. Both business and personal bankruptcies are at an all-time high. Banks and savings and loan associations have failed at a rate greater than ever before in our history. Interest on the national debt is now consuming half of all of our taxes. Heavy industry has been largely replaced by overseas competition. We're facing an international trade deficit for the first time in our history. 75% of downtown Los Angeles and other large metropolitan areas are now owned by foreigners, and over half of the nation right now is officially in a state of recession. Now that is the report card of the Federal Reserve System after 80 years of stabilizing the economy. And I don't think it's even controversial to say that the Federal Reserve has failed to meet its stated objectives. The only controversial question is, why has it failed? And my answer to that is because those have never been its true objectives at all. What are its true objectives? Well, what are the objectives of any cartel? To make money, to enhance the profit margins of the members of the cartel, and to stabilize its position in the marketplace, to prevent competition. Those are the objectives of any cartel. And if our analysis is correct here, we'll find that this, in fact, has been what the Federal Reserve System has accomplished for itself and its component members. To be more specific, it's possible to go to the period of Jekyll Island and read the papers and speeches that were done by the people on Jekyll Island and their associates. The big banks were concerned over three things, among other things, but the three main things were as follows. They said they wanted to reverse the erosion of their power away from New York. That's right, just the opposite of what the Federal Reserve System was supposed to accomplish. They wanted to keep it in New York. They were concerned because as the nation was spreading westward and southward, new banks were springing up all over the frontier. And more of the capital assets of the nation were moving in that direction. Yes, they still had the lion's share, but every year the percentages went down a little bit. And they could see where that chart was going. And they said, we must put a stop to this now while we still have power. Remember, John D. Rockefeller said it, competition is a sin. And competition from the new banks in America was something that had to be stopped. See, one of the purposes of the Federal Reserve System was to control the competition from the new banks. And this is a good place to emphasize that when I'm talking about the cartel, I'm primarily talking about the big banks in New York that created it, and the international banks as well, the ones in Europe. I'm not talking about your bank down the street that ever since the system was created has struggled and struggled under the regulations of the system, which were designed primarily, to some extent, to squeeze the competition out or to keep it in its place. And you've seen that process going on throughout the years. We have fewer and fewer banks all the time, little ones getting gobbled up by the big banks. So that was objective number one. Number two, they wanted to reverse the trend of what is called private capital formation. Now, what that means is simply this. It means that people in those days were using their own savings instead of going to the bank and borrowing. Corporations in particular found that it was better for them to withhold some of the dividends from their stockholders each quarter, put that money into a sinking fund, let it accumulate, or let the capital form, as they say, capital formation, and then use their own money to build the new factory or launch a research and development project or whatever, instead of going to the banks. And the banks were extremely concerned over this trend. They racked their brains. How do we get businesses to come back to the banks and borrow money again? And their answer was quite simple. If you were a banker, you would know how to do that. The answer is to lower interest rates, to make those rates so attractive that you'd be crazy not to go to the bank and borrow the money at those interest rates. So much easier than saving. Well, why didn't they just lower interest rates? Because that was 1913, ladies and gentlemen, and they couldn't. Money was real money in those days. It was backed by gold and silver. There was no lever on it. No man, no group of men, no politicians, no bankers could arbitrarily affect interest rates. Because it was backed by gold and silver, the money was, and they couldn't just create it out of nothing. You see, under those conditions, interest rates are the product of the forces of supply and demand in a free market economy. Nobody has control over it. And that's why the politicians hate money that's backed by gold and silver. They cannot manipulate it. So their challenge was, how can we artificially depress the interest rates below the natural level that's produced in the free market? And the solution was, they said, the nation needed what was called a flexible currency. They said, this is what industry needed to prosper, a flexible currency. You still hear that phrase today, the virtues of a flexible currency. Well, what is a flexible currency? You need a dictionary. Well, it's not paper money that folds. What that means is money created out of nothing. That's what a flexible currency is. See, the trick is not particularly hard to figure out here. If you are creating money out of nothing, you don't have to charge an awful lot of interest on it to show a profit. See, it's as simple as that. So, with a flexible currency, now they have a lever on it. And they can jack the interest rates down, 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 so that it's attractive, and they're still making plenty of profit on it because it didn't cost them anything. And they have reversed the trend toward private capital formation. And the third objective that they spoke about in those days was how to pass on the inevitable losses within the banking system, to pass those losses on to the taxpayer in the name of protecting the people. Now, let's give the Federal Reserve System another report card with these objectives in mind and see how well it has done. Did they keep control over the banking system and the monetary system in New York? And yes, they did. Anyone who knows how the markets function, it has always remained in New York. In fact, it's even more so now in New York than it was then. Yes, there are plenty of large banks in the nation, in the South and in the West, but these are small compared to those giants that are in New York, in fact, that are astride the world, with offices in Peking and Moscow and Africa, everywhere in the world. The giants are in New York, and they have been running the show all of these years. Did they reverse the trend toward private capital formation? Boy, did they ever. With interest rates brought down periodically to such attractive levels, individuals and corporations have been enticed away from saving their own money and going to the bank. You'd be a fool not to get that money at those low interest rates. Of course, then the economy contracts and things go a little sour now and then, and the fruit falls from the tree, and they pick it up. They get all your marbles. They get all your assets, your houses, your cars, your factories, your stocks, and your bonds. That's one of the reasons we've had so many bankruptcies in the decades past. Even those companies today which are hanging in there by the skin of their teeth because it's all they can do to make payments to service their debt to the banks. Notice that many of those companies are now sending more money to the banks as interest on their loans than they send to their stockholders as dividends on their stocks. Think about that. The banks which created the money out of nothing, no effort at all, no risk really of anything, are making more money out of these giant industries than the people who worked for the money, sacrificed, saved the money, invested it, and risked it. And yet the money is going to the banks. Yes, the Federal Reserve System, in fact, gets an A on its report card for reversing the trend toward private capital formation, and they did it with a flexible currency, just as they had planned to do it. And what about the third objective, which was to pass the losses on to the taxpayers in the name of protecting the people? That is something which I call in my book Operation Bailout, the game called bailout. You may have noticed every time a large bank gets into trouble, not the small banks, they're dispensable. The large banks, when they get into trouble, they're going to be bailed out by the government, which means by your tax dollars and mine, in the name of protecting the people. It doesn't make any difference if there's if it's a private corporation or a city municipality or a third world country. Whoever has borrowed megabucks from these banks and now can't service their debt anymore, they have trouble making those interest payments, which is all banks care about. They don't want you to pay back the loan because they'd have then just the problem of finding somebody else to lend it to. They don't want you to pay back your loan. They want you to pay the interest on the loan and keep those loans going forever. And finally, when people have trouble making those interest payments, and it looks like the bank is going to have to write it off of its books, what happens? They go to Congress. And they say, well, this corporation that's having trouble making its interest payments, we can't let that corporation fold because look how many thousands of jobs would be lost and people would go on welfare. There would be despair. We must protect the people. Or if it's a third world country that can't make its interest payments anymore, they say, well, we can't allow that to happen. We must make those payments for them in some way or another. Because if that venerable bank had to write that huge loan off of its books, it would technically be bankrupt. And if it were bankrupt, it might have to close its doors. If that bank were to fall, it's such a huge bank, it'd be like a domino, and it might knock the other banks down too. And we could have a major economic crisis on our hands, and look how the people would suffer. And so Congress dutifully always responds. Remember, Congress is the partner in this scam. Always rushes in and says, yes, we can't allow those bad things to happen to the people. And so they vote the money to guarantee the loans or make outright payments in some very creative fashions so that the interest can continue flowing to the banks. Some of the more memorable games you may have missed over the recent years: Penn Central Railroad was bailed out in 1970, Lockheed Corporation that same year, Commonwealth Bank of Detroit in 1972, New York City in 1975, Chrysler in 1978, First Pennsylvania Bank in 1980, Continental Illinois, the largest of the banks so far, in 1982, and of course we know how many third world countries out there have had their debts funded. The money comes from the IMF World Bank so they can continue making their payments, and the IMF World Bank gets their money from the Federal Reserve System, and the Federal Reserve System gets it from us in the form of that mandrake mechanism and the hidden tax called inflation, or direct taxes in some cases. The Federal Reserve System gets an A on its report card on all three. of its true objectives.